The Consumer Bankers Association is pleased to welcome you to today's webinar, The Wait is Over, 1071 is Here, What to Do Now, presented by Guidehouse. My name is Isabella, and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers, Kate Rock, Partner Banking, Insurance, and Capital Markets at Guidehouse, and Chris Cicaranza, Partner and Head of the Banking, Insurance, and Capital Markets Practice at Guidehouse. Kate and Chris, welcome.
Great. Well, thank you, Isabella. And thank you to everybody who's joined us today. We're really excited to be in front of the CBA audience again to talk about 1071. I think this is the second time Kate and I have actually had an opportunity to speak to this group specifically about this topic. I do think this presentation will probably be more fun than our last one now that we actually have a rule, and the rule has been out for a couple weeks, and so we've had many of our clients and those in the industry with some of the challenges that they're foreseeing, and also some of the questions that have been answered and some of the questions that have arisen with the new rule. So just real quickly, you can see our bios on the screen. My name is Chris Cicaranza. I lead the commercial financial services practice here at Guidehouse. Been serving the industry really now for almost 25 years, maybe a little bit over 25 years, focused on issues like 1071, so risk compliance issues, and then the operations and technology that support those types of things. Kate and I have worked together, I think, for over 15 years now, and so we're real excited to talk about this issue. Kate, do you want to maybe take a second and introduce yourself?
Sure, thanks, Chris, and good afternoon, everyone. We are excited to be here, as Chris said. Again, Kate Rock, I am a partner within the Commercial Financial Services Group with Chris, and I spend my time working with a variety of financial institutions, really helping them stand up and run large programs, as well as providing risk management controls and regulatory compliance solutions, including helping our clients get ready for new rules and regulations such as 1071. This is a topic that we've certainly been following before it was even a proposed rule. So as Chris said, it is I guess, catch-22 with the final rule. We're excited to have it, but know that there is a lot of work to be done for everyone ahead. So thanks for having us, and we're looking forward to it.
Great, thanks, Kate. So let's maybe advance to the agenda and talk about what we're going to cover today. So we have the rule. The rule's out. Kate's going to give us a great overview of the rule and the background, some of the key data points that the CFPB is looking for in the new 1071 rule. A number of questions have been answered with the finalized rule, of course. And so we'll talk about those questions as well as some of the changes that have occurred with the final rule. But of course, with some questions being answered, it's created some additional questions that we know people are struggling with. So we'll talk about that a little bit. Implementation challenges. We have 3 slides on implementation challenges. I think we could have had, I don't know, Kate, 5 or more, maybe 10. And I'm sure there'll be other challenges that arise over time, but we'll talk about some of those specifically. We'll give you your thoughts on how to prepare for the implementation. Like I mentioned, we've been meeting with a number of financial institutions and banks, and I've started to hear what some people are on their way to doing and can share that. And then we do have time held at the end for Q&A, but please feel free to interject using the Q&A functionality within the Zoom meeting here to ask throughout. I feel like that's a good way to make it more interactive and get your questions answered as they come up. So with that, I'll hand it over to Kate to talk about the rule and some of the background.
Great, thanks, Chris. And if we go to the next slide, what we wanted to do was just start out providing an overview of the rule and touch on some of the data points, as well as what questions have been answered as Chris laid out. So as I'm assuming most of us know, this rule was finalized on March 30th of this year, 1 day in advance of the required deadline by court order. So just in the nick of time. So we've had a little bit over a month now to do a deeper dive into the final rule now that we have it. But I guess kind of a big picture, this rule impacts financial institutions of all types and sizes. So not only the traditional depository institutions, banks, but also non-bank lenders and fintechs. And it impacts the majority of them, right? So any that are originating at least 100 covered credit transactions is defined in the rule for small businesses. So really have to have a small origination number to fall out of scope of the rule. And then the other thing maybe is many of us might have heard this referred to as the HMDA for small business lending. Many of us might have worked on that a few years ago. And while there are some similarities, I think overall, many agree that this is going to be a more comprehensive, more complex implementation effort, really for a variety of reasons. One, just the number of products and services that are falling into scope, as well as just how the operations work here. So multiple systems involved, multiple application intake channels, and really just the underwriting process as well as it relates to small business lending, and how there is perhaps more discretion in this area than maybe we saw in mortgage when we were going through the HMDA implementation process. At the bottom of the slide, we had tried to outline a little bit of a timeline there for you. We are more towards the left-hand side of the screen, but of course the rule was issued in March of this year. That first date, October of this year, is actually when you may begin collecting data. Through our conversations, we know that many likely will not be starting that until next year. They have some work to do to get ready to be able to do that, but you are able to start doing that in October of this year if you are ready. Then it is, when do you have to be able to start collecting this and be in compliance with the rule? There is a phased implementation that came out with the final rule. We'll touch on that here in a little bit, but I would believe that most of the listeners today are falling into that October 24 timeline there, where you're originating at least 2,500 covered transactions. So a deadline of October of next year. But there are deadlines of April of 25 and January of 26 if there are smaller origination volumes are applicable to you. And then the June of 25 date, which of course is that submission date to the CFPB. So if we go to the next slide, what we have done here is really listed out the data points, right? So what is the information that's going to need to be collected and reported on? And as you can see, it's 20 data point categories, but there are additional subcategories as you do a deeper dive into the rule for some of these fields. And so if you're looking at this slide, pricing information as an example, numerous subcategories you can see listed there. Same thing on the right-hand side under principal owner demographics, multiple subcategories there. I won't touch on all of these here, but did want to provide a sense to the audience of what we're talking about. And some of this is more sensitive than perhaps others. But if you look on the left-hand side, of course, I've touched on pricing information, certainly something we know our clients are sensitive about. As well as maybe on the bottom left-hand side, denial reasons. All of that information is now going to go into the public purview with this kind of data collection and reporting effort. On the right-hand side, I guess on the left, required. On the right-hand side, this is information that is to be requested but not required. And there was a new component around discouragement risk that I'll touch on a little bit later that kind of adds a new concept when we are thinking about things here on the right-hand side that, again, we should be requesting but not requiring from the borrowers, but also not discouraging them from responding to. So if we flip forward, as Chris alluded to, we did want to take a step back and say, okay, now that we have the final rule, what were those lingering industry questions that we had maybe in March before the rule was finalized that now we do have answers to, at least for the most part here? So we've come up with kind of a top four. Again, I'm sure there's more, but these are the ones that we thought were some of the biggest questions coming into the final rule. So first would be, how will the CFPB define covered transactions? I won't read through that, but on the right-hand side, you can see this is extensions of credit under Reg B. Maybe a couple of things to point out. As you can see, merchant cash advances is in. And with the final rule, they are excluding HMDA transactions. And maybe one other thing to point out here is that within the final rule, there was clarification that this includes only new originations and not purchases. And I know through many of our conversations with our clients, I think that has been a welcomed kind of result with the final rule. Number two, how will the CFPB define covered applications? So this is any oral or written request for a covered credit transactions in accordance with your procedures. So I said oral request, it does not include inquiries though. And with that, I will say it, of course, is going to be important to have clear and well-defined procedures on the distinctions between those two, and ultimately that associated training for your team members as they are working to implement those procedures. Another thing maybe I'll touch on here and as it relates to applications, and always a question that is out there is, what is the definition of a complete application? And I know through our conversations, we do have some clients where right now it is all oral or verbal applications, others where it is written, some have a combination of both. And again, I think it goes back to the making sure you have those clear, well-defined procedures in terms of how your institution is defining a complete application, and making sure that those are known to your team members, again, as they are implementing those procedures on a consistent basis. Number three, how will the CFPB define small business? There was no change here, so that definition of 5 million or less in gross annual revenue, that remains. And then last but not least, of course, the proposed 18-month implementation timeline. I know many were pushing for a little bit longer period. I guess a little bit of both. Again, I would imagine most of us on the line today do fall into that 18-month timeline with more than 2,500 transactions being included. But yeah, they did implement, again, that phased approach if you do have that smaller origination volume. If we go to the next slide, what we have been working on over the past month is really doing a deeper dive into that almost 900 pages of the final rule here. And of course, this slide does not cover everything that is out there, but some of the things that we thought were key changes between the proposed rule and the final rule in terms of additions or removals or revisions or really just kind of additional clarifications or guidance. So thought it would be helpful to touch on at least a few of these here. So first, under additions, and this first one is that idea of discouragement risk that I mentioned in the beginning. And with some of the applicant related information that again, is not required, but should be requested. But again, should also be requested in a way that is not too burdensome for the customers to provide such information. And so there are expectations to have procedures to track response rates and analyze really for discouragement risk, because that is something that we know the CFPB and perhaps other regulators would be looking at as well. And that is a little bit tricky, right? Because again, not required, but maybe you're going to get a lot of questions if there's a lot of non-responses in that area. So certainly a balancing act and a new part of the rule that seems to have caught the attention of most of the people we are speaking with. The second item there, the addition of being able to rely on information provided. And so really, I think this is helpful in that you don't have to verify the applicant provided information. Again, looking back on those data points that we walked through in the beginning, you can rely on the information that is provided without having to go through processes to verify it. Under removals, first, the application method. So within the proposed rule, there was this waterfall approach to determine what you would need to be reporting for application method. Little bit complex. They have simplified that with the final rule. So in instances where there are multiple applications, you may consider the initial one is what you are reporting under that application method field. And then another kind of positive, I think, coming out of the final rule around the ethnicity, race, and sex gender. Within the proposed rule, there was a requirement to visually observe this information and kind of put in what you think based on that observation. So that has now been removed and goes back to the idea of requested, but perhaps not required information. Under revisions, maybe I'll just touch on the first one there. There are safe harbors listed within the final rule as one example. Relating to the application date, there are revised thresholds. So it was 3 calendar days. It is now 3 business days. So giving you a little bit more time included in that safe harbor. And then maybe the last thing here before we move on is the interest rates and what is to be reported when there is an introductory interest rate period. So they have come out with clarifying guidance that says, okay, if the period is 12 months or less, use the post-adjustment rate. If it is 12 months or I guess greater than 12 months, use the pre-adjustment rate. So kind of clarification such as that throughout the finalized rule. If we go to the next section. Okay, so more industry questions. So as Chris said in the beginning, while we have some of the answers that maybe the industry had in the beginning of this year, you really get into it as you start to read the final rule and think through and perform those gap assessments, start to build out your plan. How is this really going to work and how are we going to get into compliance with this new rule? So we've listed here 6 that we are hearing regularly through our conversations with our clients, but I'm sure there are definitely many more, and I'm sure that many of you have others to add to this list as well. But the first one here, and I think this one I would say goes back to maybe something I had mentioned in the beginning where small business lending is set up a little bit differently when, for example, you're comparing it to mortgage, as we were talking about the HMDA for small business lending. And some organizations now might consider small business lending 5 million and below already. We know some are 2.5 million and below, some are 2 million and below. It's kind of a variety of how organizations have themselves set up right now and how they think about this. And ultimately what might need to change as they move forward. So do you bring everything under one umbrella for 5 million? Do you do that for all size organizations? Does it make more sense for larger ones than smaller ones? What is that threshold? And if you do that, how much do you need to standardize your processes within each of those? So if you do bring everything under a $5 million umbrella, how much discretion can you continue to have based on kind of product services, the amounts that we are talking about here? So that certainly seems to be a question that many of our clients are talking through, and we are hearing over and over as people are digging into really how are they going to operationalize this and put it into practice. The second one, will adverse action notices be required for all credit transactions? I think this is a question that maybe goes back to a theme that we have been hearing for quite some time. And of course, it's the idea that the regulators are starting to view small business through the lens of consumer. And so is that what's happening here with 1071? I think many would say yes. And then, okay, does that mean we need to be issuing adverse action notices for everybody 5 million and below? Or how do we need to be thinking about that with this new 1071 rule? The third item here, this touches on the discouragement risk that I mentioned. I've touched on it. I do think that's going to be an interesting one because we know that there were many instances where applicants were not providing such information that we saw through work with PPP, for example. So making sure that you are asking for this information, but not making it again too overly burdensome for the applicants to be providing this information. The next one, how will other regulators and action groups leverage this publicly available information? So as we can imagine, the CFPB, of course, will be looking at this information, but I think we should all be thinking that the other regulators would also be taking a look at it, as well as potential other industry or action groups. What would they be doing once this information does become public? So just knowing that that is out there and it will be being reviewed, and how will they be thinking about you and their peer groups. So this is applicable to banks, non-bank lenders and servicers, fintechs. Will they keep those peers separate? Would there be any consideration of combining a bank and comparing it to a fintech? We've heard keeping separate, but yet to be determined, I think, at this point. Community outreach and engagement efforts. So I think this gets into fair lending analysis, which I'm sure would be part of what the regulators and action groups would be looking at as well. And once organizations start collecting this information, performing fair lending analysis on that, and what are those results going to look like? So while something that institutions may not be able to do until next year when they do start collecting this information, many of our clients are already thinking about that. How would we do the fair lending analysis on this? What is it going to look like? And would that impact our kind of strategy from a community outreach and engagement perspective? Which I think kind of goes hand in hand with the last question that we have listed here today, and kind of tying it to the Community Reinvestment Act. So how will 1071 and CRA end up being aligned? We know that is ultimately one of the goals is to align these. And we also know that the CRA rule, it's in its proposed form now, expecting that final rule probably this summer. The last I've heard is July. And so once that final rule does come out, again, how does it end up being aligned with 1071 from a data collection and reporting effort? And then, of course, CRA has its own community outreach and engagement components to it as well. And maybe the last thing I'll say here on this is, of course, that the CRA proposed rule had an implementation timeline of 12 months. So if that does hold, we know every institution is going to be working on implementing both of these at the same time.
Great. So taking a look at some of the challenges we expect the lenders and servicers in the space to face. We've captured a number of challenges on 3 slides here. Generally we categorized them under systems, data, and compliance. When I think about the challenges as we move along in this implementation timeline, absolutely a data collection challenge, a big time system challenge, but it's also going to be a big change for our customers. Our customers are not used to providing us this information, and so this is going to be a big change for them. It's going to be a big behavioral change. We've talked about that discouragement risk. And so, as the industry moves through this process, we've got to think about how to make our customers more comfortable providing us this information so we can reduce that risk. Not just, I guess, an impact to our systems, data, and customers, but also our employees. Our employees are not used to, having to gather this information. And so that's going to be a change that's going to probably require some new and additional training. So with that kind of overview, if we look more specifically for, taking a look at the systems and application challenges, Kate, mentioned that, institutions are organized differently, right? So to this point, some institutions viewed small business and small business lending and banking as $3 million or less. Some are already aligned to that 5 million. So you have a lot of differences. And because of that, there's multiple systems oftentimes at play here. That will be impacted. And so I think a number of institutions we've been talking to have been trying to decide, hey, do they merge those businesses? Do they get on one system? Do they have to update multiple systems to be able to collect this information? And so, when we start talking about systems and system changes and system implementations, 18 months is a really short period of time. And so folks who are further along on that system implementation timeline, I think will be better positioned ultimately, when we get to the end and the reporting date. Another issue within systems, a number of folks in the industry have acquired other financial institutions, other banks. And so we've heard, some people have up to 8 different systems within the small business lending space. Very complicated, something that needs to be worked out over time, of course. Data firewalls. How do we keep the 1071 data, separate from our underwriting processes, or, at least making sure there's firewalls in between the two, so there's, no cross contamination. Data integration is the last thing on the slide we talk about. It goes back to those multiple systems. If I have multiple systems that are, in this small business space, that data has to all be aggregated and integrated at some point for the reporting to the CFPB, and that's a whole process in itself. Our lessons learned from HMDA, we had to help clients institute a number of control processes so that when that data was integrated and ultimately pushed on, that you had controls in place to make sure, hey, the record counts were right, the fields were populated, the data within those fields were correct, all those types of things that you would expect as you're doing a really big massive data effort. So it's a collection, dissection, and then an ultimate reporting type effort. If we kind of move on and think about more data governance and third-party oversight issues, this first one is, again, this discouragement risk issue. Some of the borrowers may be uncomfortable providing the information. And so, we've got to create methodologies and approaches that make it easy for our customers to provide the information, so it doesn't look like we're discouraging them. Our lesson learned from PPP is, many borrowers did not provide that demographic information for whatever reason. Another thing is, when you're providing, a number of the fields are free form fields, and when you're dealing with free form fields, as folks on the phone know, that can be a big challenge. You can get a wide range of inputs in those free form fields, and that creates, I think, a bit of a challenge. And so that will need to be kind of mapped out, not just when you're gathering it, but as you're integrating it and aggregating that information, how we handle some of those free form fields ultimately. Of course, those free form fields will become almost like unstructured data for us. Q&A, quality, monitoring quality is always going to be really important. We'll have to train our staff to make sure they're aware of the rules, aware of the capturing. So there'll be a change in not just our systems and our technology, but we may need to change our processes around those systems and technology. We'll have to implement obviously some new control mechanisms around that to ensure our data is correct, our data is complete, that we're capturing the right information. And then the last thing we talk about from a data governance, third-party oversight perspective is, third-party originated loans. I think we'll have a challenge originating the loans ourselves, but when somebody else is doing it, they also need to understand the importance of collecting this information in an accurate and complete way that's going to feed into our ultimate reporting processes on the back end. So that's going to be a big thing to think about as we move forward. As we think about risk management and compliance, the data is being collected, at the end of the day to do a fair lending type analysis. And so I think in the immediate term, we're very focused on how do we collect the data, how do we update our systems, how do we ultimately report the data. But all along those lines, we need to be thinking about, what are the statistical analyses that we can do to understand if there's any sort of fair lending risk within our lending and small business banking type activities. This also can be used, to better understand, are we serving, the markets we intend to serve, and are we serving our communities? So, once that data is collected, obviously a big opportunity to analyze that data, evaluate it, model it to understand what our fair lending risk may be. We've talked about discouragement risk a few times now. Kate talked about it quite a bit. How are we going to overcome that? I think this is about making that reporting easy, as frictionless as possible, training our staff to, be comfortable asking for that information. Really want to reduce the barriers to getting that data and then ultimately reporting it correctly. And then the last thing we highlighted is, this new state laws around very similar topics. We always believe having a really good, regulatory change management process is important. I know many of the institutions on this call have implemented great regulatory change management processes. As a new regulation kicks off a change management process that, creates change to processes and technology and training. That needs to be expanded, obviously, to include small business lending, particularly as this becomes, much more of almost like a consumer focused business over time, especially as states, start passing, many of the same laws themselves. Having a really robust regulatory change management process is always going to be a helpful way to really control and manage that type of risk. So those are some of the challenges we anticipate seeing during the implementation phase of 1071. As we think about preparing to implement, we've talked to a number of institutions now. Most institutions have had a working group already in place who have evaluated the draft rule and now the final rule. They've been mapping those rules, doing a bit of a risk assessment or gap analysis. We've helped a number of clients do that. So our recommendation is, if you haven't gotten started, at least get that working group started as soon as possible. There's going to be, like we've already talked about, a lot of change in your data and your systems that are going to need to take place. 18 months goes by much quicker than you think. Having a great idea of the scope. Okay, what products what products that we originate are going to be covered by the new rule. Is our business set up where we have small business 5 million and under, or is it broken up into multiple parts within our institution? So understanding not just the scope of the rule, but the scope impacted within our business is I think very important. What functions within our business are also impacted. Ultimately, we want to get to a point where we know what our gaps in our current state is. We've built a plan and a roadmap to remediate those gaps over time. Again, we know of a number of places where they've been implementing new lending systems in this space. And so they already have a timeline to know when those lending systems will go live. Those systems will be updated to capture the correct information to support reporting ultimately. For folks who haven't done that or have multiple systems, really identifying the integration points and the multiple impacted technology and applications will be, I think, very important. We talk about people as well, like people who need to be trained on the new rule. Processes will likely need to be also updated as technology does as well. We've talked about technology quite a bit. If you have new technology in the space, you're probably better positioned. If you have older technology, that older technology will probably need to be patched quite a bit in order to handle the new data requirements and the ultimate reporting requirements. So that'll be something that needs to be evaluated. And again, a roadmap produced 18 months goes by fast if you've got to implement a new technology, evaluate, pick, and then implement a new technology. So something to be, very focused on today versus waiting and delaying. Kate, anything that you would add to this slide?
I think these were our key thoughts in terms of how to get started. And I think once the technology, I think, is overemphasized because of its importance and some of the complications and how long we know that is going to take for many organizations. And I think once you have this roadmap, right, that's really kind of the key steps that you are going to need to take. So I think the idea would be you have that, and then you build your implementation team. So making sure that you have with those working groups a full idea of kind of all the impacted areas, because I would imagine those implementation teams might need to grow based on the number of tasks that you are going to need to complete, kind of as they're outlined in that roadmap. So and kind of our thinking, this is how you get started. But then there is that kind of more longer tail implementation process where you're executing against that roadmap. And then clearly much further down the line is that kind of fair lending analysis that we've spoken about, but that I think is a year away for many folks.
I think you said it right, the overemphasis of technology. Like we know how long technology takes and the challenges that can present. And because this is a technological change and a data change in many ways, that's why we've mentioned it so many times. And we know that can eat up 18 months very quickly. And so all the more emphasis on getting started as soon as possible.
Yeah, and with the technology, there's the reliance on your vendors, right? And so we know that some of the key vendors in this area that, for example, seems to be impacting many of our clients, right? Many are saying they're going to be ready, but will they really? And then is it going to be up to the standards of your own institutions in terms of what they're actually going to be rolling out within those systems? So just making sure you're staying on top of that as well. Knowing that many of these vendors have many clients that are going through all of this at the same time. So again, just another reason I think that the technology is key.
Yeah, I think that's a great point, that it's the same, that many of the same vendors in this space. And so know that they could potentially run into some capacity challenges as this gets implemented over the next year and a half. Thanks, Kate. That's the end of our prepared presentation. We did want to leave quite a bit of time for questions and answers. I know we've gotten many questions from different folks, over time, and so would love to hear from the folks on the call, the participants on the call, to see what questions they may have. And I think you can do that by entering that information in the Q&A functionality at the bottom of the screen. All right, well, it looks like we don't have any questions yet. Kate, anything you'd like to add that maybe we hadn't touched upon yet or emphasize?
Looks like we do have some starting to come in.
Ooh, okay, we've got a few coming in. So Kate, do you want to maybe take this second one first? So we've talked about data quite a bit. What about the unstructured data?
Yeah, so I think that's right. So for some of these data points, there is the ability to write in. So that is going to lead to potentially, or it will lead to unstructured data. And so I think some of the key things that Chris was talking about around that data management is going to be important. So what do I think about? Data dictionaries. So make sure you have well-defined data dictionaries, you have procedures, so that it's very clear in terms of that unstructured data and how it is ultimately going to flow from what is being input into the application to what is ultimately going to be reported up to the CFPB. So data dictionaries, procedures come to mind for me, but I don't know, Chris, if you have anything else to add to that one as well.
Yeah, I think that's exactly right. And then when you go to aggregate that data, although it's an unstructured form, or there are similarities between some of the answers that you can aggregate together. And so I think over time, we've seen this with some of the other data collection efforts, that you get all sorts of answers in unstructured fields that are open, but you can start to pull some of the information together over time. Kate, there's a couple other questions here. Any of these you want to answer directly?
Let me take a read through.
What about the adverse action letters?
Just reading that one. So yeah, we did touch on this one. This is a question that we do hear many of our clients asking us about. With this new definition of small business of 5 million and below, does that now mean that I need to send adverse action letters for everything under 5 million? So I think we are hearing a variety of thoughts on that one, where some clients are thinking, okay, why don't we just go ahead and do that? Whereas there are hesitations from many others. Some we know send at different thresholds under that 5 million already currently. And do they want to raise that closer to that $5 million number or not? So I know those are ongoing conversations, and I think we are hearing it both ways right now, in terms of clients who certainly are going to do it up to 5 million, but others who are perhaps thinking about thresholds underneath there.
Great, thanks, Kate. And then there's another question here about the $5 million threshold. If I understand it correctly, I think the question, so the $5 million threshold is about the size of the small business. And so if the small business is $5 million or less in revenue, then it's required that the demographic information is to be collected. Is that how you read that question, Kate?
Yeah, I don't think I have more to add there.
Any thoughts on this indirect lending? How is indirect lending going to be handled outside of auto? I don't know if we've been able to evaluate that one just yet. But those are the types of things that are to come up as we get into evaluating the different products that each financial institution is originating, or if they're being originated by third parties or others, how that's going to get pulled into the system. But I think ultimately you're going to need to be providing that demographic information on those individuals or those individual businesses. Let's see what else is here.
So there are questions related. Oh,
go ahead.
Go ahead. Questions related to collecting the demographic information and what threshold. So I think as you are thinking through how to think about the applications and having kind of perhaps built-in controls where, yes, if it's this 5 million and below threshold, you would be providing or asking for, I should say, the demographic information associated with that. Because you do want to make sure that you're thinking about that threshold as you are asking that question. So I would think about some potential controls in your application process related to that.
So there's a question here about what third-party technology firms support the financial institutions in this space. I don't want to name any, I don't want to seem endorsing any firms, but there are a number of financial institution technology firms that do provide technology in this space that we know a number of banks and others are implementing. I would say they're generally prepared. They're definitely aware of the rule. They're aware of the new data requirement. I think it's driving considerable amount of interest in their technology. To me, the big challenge for them is going to be scaling to meet the needs of all the institutions in the space. we do know during PPP, there was a number of technology companies that were able to rapidly, introduce a tool to the market and deploy that tool very successfully. And so I would expect to see something similar here. But I do think there becomes a point in time though where those tech firms do get stretched. And so that's why I think doing that current state assessment, understanding the limitations of what you currently have in place as soon as possible, and then building out that implementation roadmap is really important. So you're not, waiting to the last 6 months to do something and get a technology scramble and, there's nobody available to help. So I think the sooner to do that, the better. So I'm just reading through some of these. Some of these we're probably not able to answer at this point. Some of them. Kate, my understanding of loan purchases are excluded from data reporting on this, correct?
That's right.
Yeah. So if you like the loan, and that's an update to the rule or a clarification in the new rule.
That's right. In the final rule, it clarified purchases are out. It's only for new originations.
So that was a good change. Any thoughts on any of these others? Some of these are pretty detailed and specific.
I do see some in here related to interest rates. So I do think there is some clarifying guidance within the final rule related to interest rates and how you might want to think about reporting that. So again, with the adjusted rate, there are those timeframes that you should be looking at to determine which ones you want to put forward in your reporting.
And on the application front, that's a bank policy. There's a question here around the bank declaring what is exactly an application, both oral and written. I think our view there, Kate, correct me if you have a different view, but it's, the bank should have a clear policy on what they consider an actual application, and make sure folks understand that policy and then ultimately follow that policy. But I don't think there was any detailed anything different in the rule that clarified that.
And then I think the completeness of that application as well would be included in what you were just outlining.
Yep. So there's questions here around by third parties and brokers. My understanding, Kate, is that in that instance, the financial institution's still on the hook for reporting out that information, and that those third parties would need to collect it up front, and it would be included in what's ultimately reported by the bank or other financial institution. There's questions here about the presentation. I believe the CBA will have the presentation available to folks in PDF format that can be provided afterwards. I think Isabel is going to provide more information on that shortly.
Yeah, I think the remaining ones, as you said, are specific and not sure we have the answers at this point in time.
Great. Well, we appreciate everybody's time and listening. I know there's a couple of questions still outstanding here. Seem pretty detailed. Be happy to talk about some of those in more detail. Feel free to reach out to Kate or I directly. Our contact information is here on the slide. But again, thank you for your time. This is a topic that we love to talk about, and excited to help folks, implement this over the next 18 months. So thank you very much. We appreciate everybody's time.
Yep. Thank you, everybody.
Thank you, Kate and Chris. And with that, we must conclude today's program. The session has been recorded and will be available within 1 to 2 business days on our website. I will also be sending around a copy of the deck as well as a recording to all participants today. On behalf of the Consumer Bankers Association, thank you so much to our speakers and of course, everyone who participated in today's event. Have a great afternoon, and you may now disconnect.
Thank you, everyone.